New data from Equifax reveals Canada's economy is facing serious headwinds. We saw GDP contract in the second quarter, both in total and per capita terms, while businesses nationwide struggle with increasingly difficult trading conditions. So far, government spending and consumer outlays have prevented a full recession, but that momentum is clearly weakening. The job market tells the story best. We lost over 60,000 jobs in August alone, pushing unemployment up to 7.1%. These mounting job losses are already hitting household budgets hard, and we're starting to see the impact on everything from daily spending to mortgage payments. Consumer debt is now running about 3% higher than last year, though the pace of growth has slowed as fewer people take on new credit. But here is what's interesting. We are seeing a clear split in borrowing behavior. Canadians without mortgages are actually taking on more debt, while those with mortgages are pulling back sharply, forced to prioritize their housing costs over any other borrowing. Canada's mortgage debt has hit 1.9 trillion. That's up 2.4% from last year, with the average balance now sitting at 247,000. First-time buyers are staying on the sidelines despite lower interest rates and slightly softer home prices. While activity is up about 1.8% nationally, we're seeing declines in the big markets, Ontario, BC, and even Alberta. The buyers who are jumping in are borrowing significantly more. The average first-time mortgage has climbed to $430,000, up 4% from last year. And here's the big shift. New home purchases aren't what's driving the mortgage market. Renewals are. Equifax shows renewals and refinances surged 27% in the second quarter, with new originations up 15%, mostly from the massive renewal wave. And many of these renewals are delivering a harsh financial reality. Borrowers who locked in those ultra-low pandemic rates are now seeing their monthly payments jump by hundreds of dollars. These payment shocks are forcing families to cut spending elsewhere and stretching budgets in ways we haven't seen for over a decade. The pain is not spread evenly across the country either. Ontario and British Columbia are bearing the brunt, with delinquency rates climbing as home prices in these markets remain stubbornly high. Ontario's 90-plus day mortgage delinquency rate hit 0.27% in the second quarter, while BC reached 0.19%, both up from last year. Meanwhile, most other provinces are still sitting below pre-pandemic delinquency levels, confirming that the stress is concentrated in the markets that saw the most dramatic price growth. With home sales slowing and much of the market in a holding pattern, many are simply waiting, hoping for either lower rates or better affordability to break the deadlock. And there is some potential relief coming. As I discussed in my previous video, the Bank of Canada is widely expected to cut rates again on September 17th. We are already seeing lenders react to weakening bond yields, which are starting to influence lower fixed rates in the market. This could provide some breathing room both for current borrowers who are facing renewals and potential buyers who've been waiting on the sidelines. However, the question remains whether these rate cuts will be enough to offset the payment shocks that many households are already experiencing. The mortgage and economic landscape is shifting rapidly, and staying informed is crucial, whether you're a current homeowner, potential buyer, or simply tracking Canada's economic health. These Equifax insights show we are at a critical juncture where policy designs and market forces will shape household finances for months to come. For more analysis on interest rates, the Canadian real estate housing market, and economic data that impacts your financial decisions, make sure to check out some of the other videos on this channel. Subscribe and hit the notification bell so you don't miss the latest updates as these stories continue to unfold. As I said, if you love this video, You're going to love this one as well.